Hello everybody, I'm one of the coaches of Unga Academy and I'd like to welcome you to this brand new video. Today we're going to be talking about one of the most well-known strategies in the investment world, the all-weather strategy, invented by Ray Dalio. But before we start, if you haven't done it yet, I invite you to please subscribe to our channel and click on the bell below this video to stay updated on all the new content that will be released. So, the all-weather strategy, which is also called all-weather portfolio, was invented many years ago by Ray Dalio, who is a famous fund manager and owner of the Bridgewater Associates Investment Fund. The name of the strategy should already give you an idea of its purpose, which is to withstand all the seasons of the market, that is, all its different phases and conditions. In order to fulfill this function, the strategy requires a diversified portfolio that is made up of different asset classes based on their functionality, that is, asset classes that are going through a different economic cycle. This kind of diversification should lead to a reduction in the total volatility of the portfolio, and so to a more or less constant growth of the portfolio itself over time. In particular, according to Ray Dalio, there are 4 parameters or factors that affect investments: inflation, deflation, economic growth, and economic decline. So let's say that by theory, thanks to a good level of diversification on completely different asset classes, this strategy should be able to produce good results in these different market conditions. The basic strategy is quite simple. More in detail, there should always be 5 instruments in the portfolio, and these instruments should have fixed weights, and the portfolio should be rebalanced every year in order to restore the correct weights of each of the 5 instruments it contains. According to the original strategy, 30% of the portfolio should be invested in US stocks, 40% in US long-term government bonds. I'll do the test using TLT, as the duration of the government bonds in this EFT is at least 20 years. 15% in medium-term government bonds. Here I will use IEFs, as the duration of its government bond ranges from 7 to 10 years. Then 7.5% of the portfolio should be invested in gold, and the remaining 7.5% should be invested in raw materials. In this case, I'll use the DBC ETF. So the weights of these 5 instruments should be rebalanced once per year in order to restore the balance between the various components and preserve the correct diversification of the portfolio. So let's start with a test on the ETFs of the original version, so the one with the annual rebalancing. As you can see, the drawdown of the strategy is significantly lower than that of the benchmark, especially in 2008 when, as we all know, the long strategies for the stock market suffered, quite a lot. In fact, the maximum drawdown of the strategy is 14.6%, whereas that of the S&P 500 was about 57%. All in all, the annual return is only half a percentage point lower than the buy and hold, which is the S&P 500. Among other things, you can also see here that in recent times the S&P 500, due to its sudden rise, would have outperformed the strategy. However, it is also clear that the strategy would have performed way better in difficult times. If we want to analyze what would happen on a much longer time horizon, we'll need to change the instruments in the portfolio, taking indexes instead of ETFs. The reason is that unfortunately some of the ETFs I included in this portfolio didn't exist before a certain date. So I replaced the ETFs with indexes that allow for the kind of evaluation we are currently making, and I tested the portfolio again on a much longer time horizon. So here are the results of the test, which go from 1995 until today. As you see, even in such a long period of time, the drawdown has been around 15%, while that of the S&P 500 would have been around 57%. The annual return continues to be around 7.6% per year, even with a longer time horizon. One possible variation to the strategy consists in changing the rotation interval, that is, in rebalancing the instruments in the portfolio once per month instead of once per year. To evaluate the results we'd get by doing so, I took another test rebalancing the portfolio monthly. As you can see, there are no significant differences in the results we get. The portfolio used for this test is the one made up of ETFs and not of indexes, and the testing period starts from 2006. There is a slight increase in the drawdown, which is now 16.11%, and no significant increase in returns. So I'd say that the version with the annual rebalancing is the most effective. Repeating the test with indexes instead of ETFs, we can see that the annual return is almost the same as the one we've seen when we used ETFs. Moreover, it isn't significantly higher than the one you'd get with annual rebalancing. So also in this case, I definitely opt for the version with the annual rebalancing, which, moreover, is less also expensive in terms of commissions. In fact, if you rebalance the portfolio each month, you need to pay commissions on 5 transactions per month, 1 for each instrument. Whereas if you rebalance it 1 per year, you need to pay commissions on 5 transactions per year. So, using the all-weather strategy with the annual rebalancing is definitely much cheaper and so somehow more accessible. Okay, this video about the all-weather strategy has come to an end. If you liked it, please give us a like and subscribe to our channel and not to miss out on any new content. Thank you so much for watching, and we'll see you next time. Bye-bye.